Hey guys, welcome to my property market news. I'm Brett Alegre-Wood and this is the 8th of December 2008. Okay, so this week we're going to cover in the UK news bank base rate down to 2% and the impact on savings. Okay, so rather than looking at what the interest rate are, look at savings. The rise of the down valuation. Okay, the indices, who to believe, the Crossrail milestone, good news for London, and could prices go up as early as 2009, early in 2009. So we'll look at an interesting perspective, which I semi-agree with. I think it's probably a little bit early, but we'll come to that soon. In other world news, the Euro base rate drops and more rate cuts to come to follow, which is great news if you've got property in Spain, as some of our investors have, and I know myself has too. So our rates are coming down, great. And then my view on the market for this week, which is the market's turning, the discount are lowering, stock levels are drying up, and developers are having difficulty getting funding. Okay, so let's get started. All right. So first of all, Martin Lewis is one of his thing. He's saying fix your savings now. Base rate slashed to 2%. Lock in your pre-cut savings thing. One of the things that's often overlooked is that when we do look at base rate coming down, as an investor and a property investor, we think, oh, that's great news. Well, actually, it's the flip side if you're saving money into a bank account, because for them, their base rate coming down actually means they're going to make a lot less interest. And for a lot of retirees, that's bad news, because if they haven't got it invested in something like property, then what's happening, they've got it in the bank and it's earning less and less money, which may not even be, well, just be keeping up with inflation. So yeah, so interesting perspective there on that. Okay, rise of the down valuation. Creditworthy borrowers are being refused deals when they remortgage because cautious surveyors are giving their homes lower than expected valuations. Now, look, this has been happening actually all year. What we find is with Collies, in particular, Collies is owned by HBOS, and whenever you send a HBOS valuer out, pretty much whatever HBOS indice says, well, that's pretty much what they're going to down value it to, which is quite interesting. And we'll come into indices very soon, but I was just going to do this. I'll have a look at this. Surveyors are being ultra cautious, and there is evidence that they are downvaluing property by far more than national indices or even local experience would suggest is warranted. There's a lot of caution around the fears that if the surveyor gets it wrong, the lender will pursue them for redress. Okay, and that's a great fear. I mean, I'm speaking to valuers all the time, and it is a fear for them, but some of them aren't really being commercial about it. What they're doing is just downvaluing as much as they think they can get away with. Which doesn't help any of us. It doesn't help the market, doesn't help indices, because obviously then people can't remortgage, people can't buy, and a whole range of things. So it can sort of create a self-fulfilling prophecy. Okay, so let's just look at the indices. This is the independent. House prices are falling faster. Okay, house prices fell faster last month, Britain's biggest lender said. All right, and then we go down just a little bit. Falling house prices may be slowing, say analysts. Nationwide, numbers better, while consumer confidence also improves. House price falls slowly, significantly. Now, interestingly enough, on the head we're saying they're falling faster, which obviously is more sensational than the fact that they're saying they're slower. Now, just clicking through the articles, if you have a look here, Britain's biggest mortgage lender said today, we're talking about Halifax. Okay, so Halifax is saying that actually house prices are falling faster than they were previously, but then we clicked on to the independent, and here they are, falling slower. So who to believe? Well, the important thing is, if you're talking about your own property, then get specific, do your due diligence in your local area, and you'll be able to work that out. But if you're talking generally about your whole portfolio, well then, maybe take a bit in the middle, okay, or what you really think. Because personally, I think a lot of this is driven by, if you look at the people that are selling now, there's two types of people. There's those that have to, okay, that are desperate to, and there's those whose business it is to sell, okay, so things like developers. And of course, I don't touch the people that are desperate to sell because ethics and all those sort of things, but what I do take advantage of the developers whose businesses is to sell, and they need to sell on a continuous basis, so the deals are there. Okay, so the Crossrail deal goes through. Now this is only one part of it. It basically is the City of London Corporation has agreed to fund 200 million of its own money. Okay, they still have to find 150 million for the private sector, but good news for property prices all the way through, which is fantastic. Okay, then you've got, now this is an interesting one. Don't be surprised to see a big surge in growth around February 2009. Okay, as interest rates in the USA, Europe approach zero, In Euroland, they dropped to about 1.5%, and mortgage rates are cut after a few months' delay. And I'll come to the concept of lag in a minute. But it's an interesting view because a lot of people out there are actually saying that it's going to be a very short-lived recession because of the amount of monetary policy or drop in interest rates and the fiscal policy, which is like government spending, taxes, the GST, things like that. Because of the sheer level of that that's being dumped back into the economy to stimulate it, that could actually see us curve out and come out of this recession very quickly. Okay, so that could be good news. I think February is way too early. I think February we'll start to see lenders come back on tap. Now, just coming back to the final point, just on my market view. Okay, so for me, I see it turning. And I've seen the last 2 months the market turn. Lending's coming back on tap. Okay, I think we're at the bottom, but we've still got a lot of risks. Okay, so there could still unemployment could get out of control. But I think lending is easing, and there's no doubt about that in my mind. Okay, the other day I applied for a mortgage, and 7 days after, the value has been in, and I've got, well, sorry, I haven't got a formal approval, but I should get one tomorrow. So that's really great news. Effectively, within a week's turnaround, I can get a mortgage, and then I'm looking to complete on that by the 19th of December, so which is only 11 days away. Okay, so very quick turnarounds. Now, there was a time when it could take 3 months. Okay, lending's easing. Now, I don't think there's a funder on the planet that wants to release a fantastic product right now, given all the interest rate drops. Why? Number one is because Christmas is coming up. All their underwriters go on holidays, and so there's sort of a 2 to 3 to 4 week period where they don't want a lot of business. And so so the last thing they want to do is release a good product and get lots of business. I think middle of January to February is when we're going to see some good products coming out. The interesting thing is, over the last 2 months, discounts have been lowering. They've been getting lower. So whereas we've seen stuff up as high as 56, albeit off an inflated valuation, we're probably seeing 25 to 30s off a RICS valuation. Okay, and that's a Colliers RICS valuation, which is great news. So they're now starting to drop, and if you like, the stock levels are drying up. So a lot of the stuff that was heavily discounted a few months ago is actually starting to come down, and really the stock's not as out there as much. Now, the other side is the off-plan side, which means the developers now have sold their stock and they want to get selling more or get developing more, is that they're finding it difficult to get the funding, okay? Because the banks right now don't want to lend to an asset that potentially could be going down next year. So they're having a lot of difficulty. And what that's doing is it's creating the supply or dropping the supply levels. Meanwhile, as with this confidence that comes back with the interest rate, demand will increase, and that could create the turnaround very quickly. Now, one concept that I want to raise, okay, the concept of lag, all right, and that's simply that everything that happens today, the effect is drawn out over the next 2, 3, 4 months, 5 months, 6 months, 2 years, okay? So don't expect a decision to be made and then straight away the effects to be felt. You've always got to consider lag. So interest rates drop to 2%. What's the lag effect attached to that? And it could be several months away before we've felt it. Okay, well, I'm Alegre-Wood. Thank you very much, and we'll see you next week.